CNBC has reported that the Fed is poised to approve a quarter-point rate hike this week. This is Zach with the Money Channel. I think it's best that we take a look at what's happening here. As an overview, market pricing and the views of numerous Wall Street experts suggest that despite the ongoing turbulence in the banking industry and the looming uncertainty, the Federal Reserve is likely to approve a quarter percentage point increase in interest rates next week. Rate expectations have been fluctuating over the past 2 weeks, with some predicting a half-point hike, whilst others have talked about the possibility of a rate cut. However, it appears that a consensus has emerged that the Federal Reserve, led by Chairman Jerome Powell, will seek to emphasize the need to address inflation while also being mindful of the challenges posed by the ongoing financial sector upheaval. This is likely to take the form of a 25 basis point increase in rates, accompanied by a commitment to flexibility, with the outlook subject to change depending on market conditions. The markets appear to be in agreement that the Fed will indeed raise rates. According to data from CME, there is a 75% chance of a quarter point increase, while the remaining 25% anticipate that the policymakers might take a more cautious approach. Goldman Sachs is one of the most high-profile forecasters predicting no change in rates, as it believes that central banks are likely to be more circumspect in the short term to avoid exacerbating market fears about the banking sector. All of the media outlets framing this as a simple trade-off between inflation versus bank stability are vastly oversimplifying this issue. We're a decade late in unwinding zero interest and quantitative easing, and if the Fed flinches because a few banks are in trouble, they will cause themselves a far bigger problem in a few years down the road. The Fed need to get both the financial system and the economy overall back to an environment where real rates are positive and risk is priced appropriately. 15 years of this have introduced all sorts of distortions that are going to be painful to fix, but waiting will make it worse. We are feeling pain because rates should have started creeping up back in 2013 to 2015. Now they are having to do so much at once. The last 15 years have been nuts on financial markets, and honestly, I'm not sure if we can even recover. Global aggregate debt went from 70 trillion in 2007 to around 300 trillion today. That 230 trillion in debt funded only 40 trillion in global GDP growth. Now, with the era of absurdly cheap money ending, the cold reality of servicing all that debt is going to start to chill everything, I think. Brilliant, my dude. Couldn't have said it any better, and you even touched on servicing that debt. 5% of 30 trillion is one thing, 5% of 300 trillion is a whole other ballgame, especially when you consider spending and tax revenues being nowhere near enough to manage those debts. Something has to give, whether it's cutting, spending, raising taxes, or both. Armchair economists armchair here, but would that not be explained simply by the majority of the debt being captured by the 0.1%? It's not really moving around, it's not producing much, it just inflates numbers, but it inflates both sides of the equation equally. You do realize that the unemployment rate in the US in 2013 was 8%, right? Why would you want to hike rates to increase unemployment if it's already way too high? They don't bother thinking this through. They also don't find the irony they are backing Warren's statement when she is more dovish on the rates. The ultimate irony is this person is complaining the French government isn't doing enough to address unemployment in France and can't seem to connect the dots. I'm sympathetic to quantitative easing, zero interest being a problem, but the unemployment rate didn't get below 5% until 2016. The Fed started raising rates when Trump was president, but immediately set them to zero when COVID hit. I think Reddit trends to younger people, so Zoomers here saying we should have raised rates sooner don't remember what 08 was like. One reason we have a teacher shortage is after 2008, because the unemployment rate was so high, states were forced to lay off teachers. So teachers decided, hey, if my pay is low already and I am the first to be laid off, I am just going to quit the field entirely. That alone had negative repercussions that we are still feeling in 2023 from teachers laid off after 2008. How old are you then? I remember 2008 and I'm married to a teacher, and the current burnout rate is effing nuts and has nothing to do with whatever you're going on about. This is like still blaming cash for clunkers for current car prices. There are teachers burning out today that were in middle school in 08. It was the banks and corporations who created the disturbances which led to the drawn out 0% interest rates over a decade ago. The same institutions are now trying their old tricks to get Big Daddy Fed to back off the rate hikes. There isn't, and never should have been, too big to fail. Now we all get to pay the piper. But the Fed didn't have to go down to near zero interest rates. They could have just let us feel the pain. Now the cure of back then is actually the pain of today. It's the Fed's fault. It's also not that simple, sadly. Americans can only afford homes and cars with near 0% rates because wages have been stagnant for 70 years. Even after the Great Recession, wages stayed flat because companies prefer to spend profits on stock buybacks. So they can stay the course for market stability, yes, but the markets will still cease to function when 70% of Americans can't buy big ticket items. Also, the Fed floated $400 billion to banks over the weekend, so not quantitative easing, but desperation. And those in homes at those rates are effectively captive, since it's both implausible to move and remortgage at a higher rate, and the home they live in is effectively worth less since a prospective home buyer has the same issue. They're not captive, but if you want to buy a house and already own one, more than likely your best bet is to rent out your current home. This is what I most likely will do. I'll buy a house and rent out a room to a young professional or college kid to help with mortgage payments. I'm 36 and I don't really want to buy a house in this environment. My brother is pushing me this one house that is $299k. It's seen as a 62% increase in value since 2019. Ridiculous for a 1,000-ish square foot home, but $299k on a 70-80k salary isn't too bad. But I just think I would be over leveraging myself. My buddy owns a few places as a retirement type investment. We were talking about how he can't sell the one he's in when he gets married, but the next one will be so expensive with high rates and no housing inventory. It doesn't matter that his house increased in value if they all do, and it's only because supply has been fixed since 2006. It's all fundamentally broken. I'm not shedding a tear for anyone hoarding property while the rest of us are messed into holding the bag on both inflated home pricing and sky-high interest rates. What does an increase in this mean in layman's terms? How could or would this affect the average person like me? I don't understand this stuff, but I'm slowly trying, thanks. The Fed sets interest rates higher in order to slow down the economy. They do this because inflation is too high, and by reducing the demand in the economy, they can help bring prices down, i.e. slowing inflation. To an average Joe, the higher interest rate means that loans will be more expensive, higher interest on things like mortgage, credit cards, car loans, etc. It also means that businesses may decide to cancel projects because it's too expensive to borrow the money now. For example, a business that was going to use loans to build a new factory may cancel that project or put it on hold. As a result, this can mean less jobs and or layoffs by some businesses. This results in a tighter budget for some working class Americans. The upside is that this can also mean less spending, which means stores are going to have to keep their prices lower to attract customers. That helps keep inflation under control, which is a benefit to American workers. Long story short, the Fed is trying to get the inflation under control by slowing down the economy. They do this by raising interest rates. The ongoing debate is how fast to raise the rates and how high to raise them. If they go too fast, they could send the economy into severe recession. If they go too slow, inflation could keep getting higher. The 0.25% raise is basically what everyone is expecting this month. If the Fed doesn't raise at all this month, it signals they are going to let inflation run higher because they're worried about the recent back turmoil. If they raise it 0.5%, it means they're willing to risk more bank issues and more market control in order to get inflation under control. The Fed meets in times per year to decide whether to adjust interest rates. A single rate adjustment really isn't going to have any noticeable effect on the average Joe American. However, the cumulative total of all the rate adjustments will significantly impact the economy. Everyone in the financial world gets worked up about each new rate adjustment because they want to try to predict what it means for the future. It's sort of like a person keeping track of a basketball game on their phone. They want to know when each team scores and they celebrate or get upset each time. However, each score doesn't really matter, it's the cumulative effect that actually affects the outcome of the game. Likewise, each individual rate adjustment doesn't mean much to the average Joe, but the financial professionals are watching it closely, just like how a basketball fan might watch the whole game, but a less interested person just wants to know who won. We need to get interest rates above the rate of inflation. I support the move. The failure of a few regional banks has more to do with their own mismanagement than anything else in my opinion. Correct SVB locking up half their funds in 10 securities was absolute negligence by their directors. Once rates creeped up, they had absolutely nowhere to go. Had they done 3 to 6 months securities, they'd still likely be in business today and absolutely doing fine. You're assuming all the banks aren't mismanaged and holding bad collateral or making overly risky investments. Let's hope you're correct. However, I'm not that optimistic. I feel like the failures are just getting started. I also wouldn't call Credit Suisse a regional bank.